Morning, welcome to the program Gyan Se Kalyan. My dear friend, we are proceeding to the next part of basic of accounting. This we have started for the benefit of learner, beginner of accounting, and who are doing class 11, 12, MCOM, BCom, MBA, CA, CS, ICW, because the basic is very important for any subject. So today we will discuss the very important item, long-term liability. So long-term liabilities are also called non-current liabilities. It includes long-term borrowings, deferred tax liability, other long-term liabilities. So resources are very important. Money is very important for any business, for any man, for any activity, for our life. Also, the money is required. Without money, we can't. So, my dear friend, just I am remembering one very good quotation. Usually, our friends are telling, "Taka haste, taka dharma, taka karma, टका ही है परम तप यस हस्ति टका नास्ति स दर दर टकायते." हियर टका मीन्स मनी. जिसके हाथ में पैसा है वो उसके पास सब कुछ है, और जिसके पास में पैसा नहीं है, सो माय डियर फ्रेंड, मेरे प्यारे मित्रों, हम लोग जानते हैं कि वह हमेशा सभी जगह वंचित ही रहता है. सो टुडे for the business, for running the business, money is very important. So the long term liability is very much required for investing in long term assets, for creating infrastructures. So first item is the borrowings. The total borrowing can be categorized long term borrowings and short term borrowing, and the current maturity to long-term debt. Loans which are payable in more than 12 months operating cycle are classified as long-term borrowings on the face of the balance sheet. So we have already discussed the current liabilities are those liabilities which are payable within a year, and the long-term liabilities are those liabilities which are payable beyond 1 year. So here we are discussing capital receipts. So capital receipts are also the long-term receipts. It implies an obligation to return the money. These are capital receipts. So the money which we have to return, this is also called liability. Liability means the amount which we have taken and we have to return it to the lender. So here some of the examples are given: an additional capital and the capital brought in by the owners for running the business, loan taken from the bank, debt issued by the company, and the outsider liabilities are long-term liabilities. So again we are proceeding to the capital receipts. Here it can be, so the capital receipts can be by sale of fixed assets, but these are not the liability which are refundable. If we are selling land, building, plant and machinery acquired by the business, so this receipt does not incur an obligation to return the money. So here we are proceeding. Long-term liability, all liability other than the current liability are known as long-term liability. Very Simple definition. Such liability are usually payable after 1 year of the date of acquisition. The important items of the long term are bank loan, fixed deposit taken by the company, and the loan taken from the financial institutions. Long-term liability also includes obligations which are expected to be paid after 1 year. So here, some of the other liabilities include bonds, long-term notes, and lease obligations. So just we have seen the bonds is one of the very important component of the long-term debt. So bonds are a form of interest-bearing notes payable issued by corporation or company, government and governmental agencies. So bonds are similar to this share capital, can be sold in a small part or portion or denomination, and such a result they attract investors. Why bond is very important? Why it is issued? From the standpoint of the corporation seeking long-term financing, bonds offer the following advantages, or these are the basic features over the share capital. Shareholder control is not affected, so they don't have the voting power. Income tax saving result, it saves the income tax, and earnings share may be higher. So we all know, in case of the financing of a company, in case of the company financing, when we are reducing the equity share capital and increasing the debt in the total share capital structure, naturally per share earning increases. So this is the principle of financing. So disadvantages are here, some of the major disadvantages of bonds. Interest must be paid on periodic basis. Interest bearing, in case of the shareholder, so there is no interest, it's payable. So principal face value of the bond must be paid at maturity, but this is not in case of the share capital. So here some of the types of the bonds are given. So bonds may be secured bond and unsecured bond. So we all know securities are provided for the secured bond, such as pledge, collateral security. A bond can be secured by real estate or other assets as well. Unsecured bond, against which no collateral securities are given. Again, the bonds may be registered bond and the bearer bond. So the bonds again can be convertible and redeemable bond. Convertible bonds are those bonds which can be converted into share at the option of the bond holder. And redeemable bond which can be redeemed or retired at the stated amount prior to the maturity is called redeemable bond. Retractable bonds are subject to redeemable and redemption prior to the maturity at the option of holder. So how we can issue, how a company can issue a bond? So here, my dear friend, very small and brief description is given. The face value is the amount of the principal due at the maturity date. The contractual interest rate, often referred to as the stated rate, is the rate used to determine the amount of cash interest the borrower pays the investors. So another very important thing is a bond certificate is issued under the contract so that the bearer can have the authority over the bond. So it is the authorization by the board and printed. How can we determine the market value of the bonds? So the market value, that is the present value of a bond, is a function of three factors. There are three components which determines the value of a bond. The amount to be received, the length of the time, that is N, unit the amount are received, and the market rate of interest. So these are the basic components of the market value of a bond. How we can record the bonds? Here small description about the accounting for bonds are provided. The face value, below face value, that is the discount, and above the face value, that is the premium. So bonds can be issued at par, at premium, or at discount. So here small and one simple example is given. We have already discussed the accounting treatment, the golden rules of accounting under personal account, real account, and nominal account. Under the personal account, the golden rule of journalizing age, debit the receiver and credit the giver. And under the real account, debit what comes in and credit what goes out. And under the nominal account, that is debit all in expenses and losses and credit all the incomes and gains. So my dear friend, here under that rule we have passed this journal entry. So discount or premium on bonds. So as we have already discussed, the bonds can be issued at par, at face value, at premium, more than face value, or at discount, less than face value. Accounting for other long-term liability. So it is very similar to the other journal entry. So we have already discussed it. A long-term note may be secured or may be unsecured. So secured loan are the mortgage and that pledges title to the specific assets as a security for a loan. Mortgage notes payable. So it is mortgage notes payable are recorded initially at face value and entries are required subsequently for each installment payment, fixed premium payment, and the interest payment. Lease liability and operating lease. So lease is again very important things in case of business operation. In an operating lease, the intent is temporary use of the property by the lessee with continued ownership of the property by the lessor. The lease rental payment are recorded as an expense by the lessee and as revenue by the lessor. So, lease liability and capital lease. A capital lease transfer substantially by all benefits and risk of the ownership from lessor to the lessee. In lease capital, the present value of the cash payments for the lease are capitalized and recorded as an asset. So, long-term lease and the short-term lease are there. So, again we are proceeding. Lease liability and lease capital. The lessee must record the lease as an asset as capital lease is if any one of the following condition exists. The lease transfer ownership of the property to the lessee. For example, contains a bargain purchase option. The lessee term is equal to 75% or more of the economic life of the leased property. The present value of the lease payment equal or exceed 90% of the fair value of the leased property. So, my dear friend, here one small interest coverage ratio is given. Interest coverage ratio measures the company's ability to meet interest payment as they come due. It is calculated by dividing income before interest expenses and income tax by interest expenses. So here, my dear friend, brief introduction about the trust on behalf of which we are providing these all services. This trust is dedicated for the welfare of humankind. Vishwa Manav Kalyan Charitable Trust. This is registered under the Trust Act and also registered under NGO Darpan Niti Aayog Government of India. You may join, donate. Our basic concept and motto is each one, teach one. Thank you very much.